let's kick off firstly with your view on the shilling, because as we see, we start off the trading day today with the shilling on the back foot, 83.80. It's starting to tick up. It has been pretty much in a range for some time now. Are you concerned about the impact that this rising risk aversion could have on the shilling?
I think part of it is the rising risk aversion. Part of it is also the fact that we've got an imminent signing ceremony, probably tomorrow, on a $600 million loan. And I think we've seen a massive fall in yields ahead of that signing ceremony tomorrow. So the local money market rates, whether it's the one-year T-bill, have fallen considerably in the last 4 weeks. And I think that's what's undercut the shilling near term. The move isn't that dramatic, and we were around the 83 level for most of this year. We're now 83.70. We can probably trade as low as 85. But I think, you know, if I look at the economy as a whole, I think we can live with a slightly weaker shilling, but we certainly need lower rates second half. And we need some kind of movement on the CBR rate, which is now 556 basis points above the one-year T-bill rate.
Let's look at those yields on T-bills, as you say, because there's that disconnect between the CBR, which is, of course, the central bank rate, and those yields.
Yeah.
But the fact that the yields on T-bills have started to come down has meant that the central bank can start coming into the market and issuing longer-dated paper, targeting that 5-year, 3 billion shilling loan. What were your thoughts on the announcement of that longer-dated paper coming into the market once again?
Well, I thought the central bank showed a lot of street smarts. They cut duration dramatically as rates went higher. They only sold sort of 1 year and under paper. I think that made a lot of economic sense. And I think now they've got interest rates more, you know, they've got the government of Kenya yield curve in a place they feel a lot more comfortable with, and they can see there's plenty of appetite. I think it makes sense for them to sell longer duration paper. And the market is actually crying out for long-term bonds. If they slotted a 10-year benchmark 10-year or even a longer bond, it would be oversubscribed, you know, many times over. So it's really working in their favor. And I, for one, think, you know, it's the right move to start extending duration. They've played a clever hand. They've maneuvered the market where they want it. Now is the time to slot the market some longer duration paper.
Let's move on to the equity market. Kenyan Shilling, of course, continues to be in the news with regards to the possible buyout by Puma Energy. Just in terms of news flow, we know that the MD of Kenyan Shilling might be taking up the offer to buy 20 million shares, of course, that under the executive compensation scheme. But overall, this is big news for Kenya right now. What are your thoughts on this deal if it does go ahead according to plan?
Well, I think, first of all, you know, the oil and gas sector is simply red hot in this region. I think it's the last major undiscovered, now being discovered lake of hydrocarbons, and there's plenty of excitement around it. What I found interesting about this transaction is this. I think this is a very clever way of inserting Puma into the landscape, the oil and gas landscape. I think it's a cheap, you know, Kenyan Shilling looks very cheap to me on a price earnings basis of 5.5. Let's say they pay a premium, they buy it out at a P of 8, they're getting in at a 44.4% premium to the suspended price. It makes sense to me on the side of Puma. If I were the shareholders, the majority of shareholders of Kenyan Shilling, I'd be looking to keep some skin in the game via staying invested in Puma. But I think ultimately, you know, Seligman said he was looking to make the company attractive to a takeover target. He's done what he said. I think, you know, it looks very promising. And it furthermore tells me that the stock market remains undervalued. In many, many cases, this is just one of them.
We've been talking about that for some time now, but you know, the market really has managed to gain some traction this year. Of course, it's been on a much firmer footing this year. But if you had to come into the market right now and look at the most attractive stocks, is it still the KCBs, equities, those stocks that foreigners continue to buy, the e-bills, which is considered a little too pricey right now? Or where do you see the best value in the Nairobi Stock Exchange at the moment?
So I think the first thing is we were coming off of oversold position. It was really quite egregious at the back end of last year. We've had a 12.29% rally in the NSE 20 index so far this year. Obviously, we got some valuations which look a little bit rich. I know Renaissance, for one, are a seller of EABL. I think that's the wrong trade. I think EABL is the proxy for the big international investors to come into the African market. They've broken out of their golden cage, which was Kenya. They've expanded geographically. They're going to have phenomenal full-year results because they've got a book a one-off gain from the sale of their shares in Tanzania breweries. So I wouldn't write off EABL at this level, not at all. I think that's going to be a favorite destination for investors through the rest of this year. Banks, you know, the likes of Kenya Commercial Bank up 41% this year, tremendous rally. But remember, all our banks simply were created in Q4 as the interest rate was hiked viciously all the way up to where it is today. So they again were coming off a low base. I think there's a lot of value still in KCB. We're trading with a P handle of 6. It looks cheap to me still. I think it goes up to a P of 8, 9. I'm looking also at some of the stocks like BAT, these industrial type stocks, which also have value. They're trading on Ps of 9 and 10. So I think you've got to be a little bit careful. It's a stock pickers market, but I still think that the index has as much of a rally as it's had so far this year still to come through year end. And I think investors continue to allocate more money. It's predominantly a foreign investor driven market. Retail investors are sidelined. They're still suffering from IPOs which remain below the IPO price, but they eventually too will participate, I'm sure.